Alright, for this video, we want to go through a sample form 8889 for health savings accounts. And this is going to be for the 2023 tax year for a single filing taxpayer. So in our example here, we have a single filing taxpayer, no dependents, and he has self-only coverage through a high deductible plan with an HSA. And during the year, the taxpayer here withdrew funds, a portion of which was not used for medical expenses. So he withdrew $1,000, only a portion was for medical costs, the other was not used for medical expenses, and so he has an income inclusion and he needs to report some additional tax because that happened. So we've got the full 1040 here, so we'll cover the 8889, and we need to cover Schedules 1 and 2 for the income inclusion and the tax, so we'll come back to those. And then I do have one slide here covering some details and background on the HSAs, and then how we deal with these distributions and qualified medical costs. So the HSAs are available if you have a high deductible plan. If you don't have a high deductible plan, you generally can't use the HSAs. Now the amount of contributions, the money you can put in during the year, for 2023, self-only coverage is $38.50. And if you have family coverage, so that's more than one person covered, it's $77.50. Now, when money is withdrawn from these HSAs for qualified medical expenses, all the distributions, no matter what the character, are reported on a 1099 SA. So you get a copy of that, a copy goes to the IRS, and now it's your responsibility to figure out, okay, of all the distributions that came out, how much were actually used for qualified medical expenses and how much of the distributions were not used for qualified medical expenses. To the extent that you have amounts that were taken out not used for qualified medical expenses, then you have this income inclusion and you have a 20% penalty that can potentially apply. All right. Now, taxable HSA distributions. So again, it's distributions that weren't used for qualified medical expenses. And so the amount that's not used has to be included in Schedule 1, Line 8F. Now, if all of your distributions were used for qualified medical expenses, then there's no income inclusion, right? So the money comes out, it's used for medical expenses, that's it. You don't have to include any amount in income, you don't have to pay any 20% penalty. But in this case, any kind of taxable distributions are going to be included in income and subject to that 20% tax, which is effectively a penalty. Now, the penalty amount is reported on Schedule 2, Line 17, and then the income inclusion is Schedule 1, Line 8F. Now, if you have to withdraw the money and you can't use it for qualified medical expenses, the 20% penalty does not apply if the person that is the account holder is either disabled, they're age 65 or older, or they're deceased, right? So if one of those exceptions applies, there's still a taxable income inclusion, but there's no 20% penalty. All right, so let's have a look at our example here. We've got John Smith. He's covered by a high deductible plan at work, and through this plan, he also has a health savings account set up. Now, in 2023, the employer put $2,000 into that HSA. So this is reported on John's Form W-2, Box 12, Code W, and that contribution is not taxable income to John. The contribution does get reported on the 8889, and we'll look at that in a little bit here. Now, John made no additional contributions during the 2023 year, so the only thing that went in was the $2,000. Now, as far as the withdrawals, John took out $1,000 from his HSA. However, only $700 was used for qualified medical expense. The other $300 was just pocketed by John. He didn't use it for qualified medical costs. So how does all this get reported? Well, if we start with the 8889, we've got the name of the taxpayer, taxpayer ID, and then on box 1 we have self-only coverage because this is a health plan that only covers John, so one person. He doesn't have a spouse or any dependents. Now, line 2 is any HSA contributions made by John during the year, and it does not include any employer contributions. Employer contributions are reported on line 9, right? So again, this is your Form W-2, Box 12, Code W, you would see an amount for your employer contributions to the HSA. Now, line 3, given he has self-only coverage and he's under 55 at the end of the year, the limit on the amount he can put in is $3,850. He doesn't have any Archer MSAs or regular MSAs set up, so nothing applies there. So the max limit that he could contribute to these plans during the year is the $3,850. And so the amount that was put into the account was $2,000. And so he has $1,850 left over. The point of this is to reconcile how much was actually put in, and if there was excess contributions, then you have to worry about an excise tax, right? So we want to make sure that during the year we're only putting in amounts into our HSA that don't exceed those thresholds. So he has no HSA deduction for the year because he didn't put in any other contributions, and the amount that the employer put in isn't included in his taxable income, so there's no need to also take a deduction for it. So the real issue John has here is in part 2. So total distributions received during the year is $1,000. Now, distributions means money that actually went to you personally, and then you spent the money on medical care, or money that was spent directly because you used the debit card, right? So if you use that HSA account, debit card, that doesn't get, it's not necessarily received by you, but you did spend the money for medical care, or if you use a debit card for another purpose, it still counts as a distribution. So $1,000 came out. There's no rollover that applied in this circumstance, so 14B is 0. So $1,000 of total distributions. And then on line 15, we have the qualified medical expenses that were paid using that distribution amount. In John's case, he only used $700 to pay for the medical care. He didn't have $300 of other qualified medical care expenses. So the taxable distribution here is subtracting line 15 from line 14C, and we're left with $300. Now, the $300 amount is included on Schedule 1 of Form 1040, Part 1, line F. And then on line 17B, we have the 20% additional tax on the $300. Now, it does ask us here in 17A if any of these distributions meet the exceptions. We can check here, and then you can report a 0 for the additional tax. In our case, we didn't meet any exceptions, right? John, he's not disabled. He's under 65. And he's not deceased, he's still living. So these funds aren't being withdrawn by the executor of his estate. So he's got $300 of income, $60 of tax, so additional tax that needs to be included. So if we have a look at Schedule 1, additional income and adjustments, we can see here, Part 1, line 8F, income from $88.89. There's the $300. So this gets included with John's income. And if we look at Schedule 2, go down to Part 2, page 2 of this schedule, we have line 17C, additional tax on HSA distributions, and there's that $60 figure. So if we have a look at John's Form 1040, we can see line 8 here from Schedule 1. There's the $300 inclusion of that taxable HSA distribution. And then if we have a look at page 2 of 1040, we can see line 23, the other taxes from Schedule 2, there's that $60. So he's got the $300 of income inclusion, a $60 tax penalty that needs to be added to his balance. And so that's the net result of him with his HSA activity for the year. All right, so that covers it for this video. Hope that was helpful. Any questions, feel free to leave a comment below. And as always, I appreciate you watching, and I look forward to seeing you on the next one. Thanks.